Let's take a look at this week in the equity market. Certainly, they sold off a fair amount, apparently in response to the resurgence of the coronavirus. We thought maybe there'd be a second wave. Maybe we didn't know the first wave hadn't left. What does that tell us about the future course of this recovery?
It will be uneven. I wrote in a client letter a couple of months ago that biology will drive the economy, and you can't harness it to our exact time frame and a very straight line. And so we will have what is likely rolling waves instead of the first wave and a second wave. And so I think we're thinking about this in far too compartmentalized of a way. And it really is a dial, not a switch. And that means that the dial will go back and forth until we get it right. And it will roll through various cities, various industries, and various geographies differently.
And the virus clearly is driving a lot of the turmoil in the market, certainly the downturn economically as we shut down. But this is sort of multiple crises coming together at the same time. I mean, you've lived through in your professional career several crises individually, but I'm not sure we've ever seen so many come together all at once.
You haven't, and that's a really good point. It's important to zoom out every once in a while, and the one that makes this one different is certainly because it's biology, and it really is something that's affecting in a global pandemic way everyone at the same time around the globe, to some degrees harder hit than others in various regions. But even world wars didn't occur virtually simultaneously across the globe and in your homes. And so you are seeing it permeate every facet of everyone's life. And you do have a more globally interconnected world today than you've ever had before. And so supply chains are being interrupted. Obviously, we all depend upon the healthcare supply chains in terms of treatments and supplies and getting back to work. And so this has been very different in a lot of ways. I would say that the sheer scale and speed of the intervention that's been done, both on the fiscal side and the monetary side, is also unprecedented. 25 to 28% of GDP in the U.S. And 19 trillion of stimulus that's been pumped into the system. So I referred to it the other day as a clash of titans, the virus versus stimulus. And you know, it really is a pretty intense period, but I am confident we'll get through it, but it won't be as quickly or as clearly as I think we're all expecting, and the markets are sometimes discounting.
So, Michelle, what's an investor to do in that climate? You're advising them all of the time. There's a lot of uncertainty, maybe a lot of fear even in the marketplace. What's the wisest course for an investor in this environment?
Yeah, well, emotion is the single greatest destructor of value. And I do know and I appreciate even the most sophisticated clients around the world are on Zoom calls with each other and with us on a weekly basis, trying to make sure that we understand how best to navigate through it. So it certainly is not for the faint of heart. But just to put it in perspective, if you go back to the low that we had in March of 2009, we're still up close to 17% through yesterday on an annualized basis. And so if you would have asked me back in March of 2009 if I thought we would be on a path, including a global pandemic, of having a 17% annualized return, I'm sure I would have taken the other side of that bet, but we have. And so economies are incredibly resilient. People are incredibly resilient. The stimulus that we've gotten has been enormous, and the scientific community is incredibly focused on finding treatments, on making sure that we're equipped to handle the cases that come through the hospitals. And we will find a vaccination. It just will be longer than not. So I would say stay the course. It's what we're saying to a lot of our clients. You want to have a strategic asset allocation. You played a clip of one of my comments that it's not about beating benchmarks. While that's important, the point is, when do you need this money and how should you be invested for the long haul? So we've had very interesting conversations, even within our family, about why would anyone put money into a
Right.
security, a bond in this case, and get a guaranteed negative return. And so equities are a good place to go, but you do need to be careful. Buy on the dips, pause when we go into
Right.
V-shaped recoveries in the markets, and just recognize
Right.
that this will be a retracement every once in a while as we make our way through what likely is to be, a year-long or more process with the virus.
Right. And Michelle, just briefly in the end here, within equities, do you need to make a bet between the so-called stay-at-home, sort of the big tech, based on really our staying home and working from home, as opposed to the recovery, the cyclicals?
You really don't. This is where active management can shine. And underneath the covers, there really is a lot of activity. There are a lot of great companies, a lot of great values. And so indices clearly have a place, but so does active management. And I think that this is where professional advice really shines through. And a highlight just for the entire industry is making sure that we're protecting financial security for people and making sure that the industry is focused in a way, not on just security selection, but on making sure we understand what the real needs are when people need the income, especially when it gets disrupted like it has recently, and make sure that we're managing toward those outcomes rather than stock by stock or industry by industry.